On October 22, 1907, a line of depositors stretched for 3 blocks outside the Knickerbocker Trust Company on Fifth Avenue in New York City. They were not farmers or factory workers. Many of them were doctors, lawyers, and merchants, the kind of people who trusted their savings to an institution that had never missed a payment in its 34-year history. By the time the doors closed that afternoon, the Knickerbocker had paid out over $8 million, and it still wasn't enough. The bank was finished. Within 4 days, the panic that began with a failed attempt to corner the copper market had metastasized into the worst financial crisis the United States had faced since 1893, and it would end with one private citizen, J.P. Morgan, deciding which banks lived and which ones died. That is the story most people know. It is the story told in textbooks, in documentaries, in the Federal Reserve's own official histories. Morgan the hero, summoned by fate to save a nation that had foolishly refused to build a central bank. But the paper trail left behind by the men who survived the panic of 1907 and by the men who quietly profited from it tells a more complicated story, one that historians have been reluctant to fully reckon with because it implicates the very people who wrote the rules that followed. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. To understand what actually happened in October of 1907, you have to understand the strange architecture of American banking at the turn of the century. The United States had no central bank. It had not had one since Andrew Jackson killed the Second Bank of the United States in 1836, and for 70 years afterward, the country ran on a patchwork system of state-chartered banks, nationally chartered banks bound by the National Bank Act of 1864, and a newer, faster-growing category of institution called trust companies. Trust companies were the shadow banks of their era. They took deposits, they made loans, they behaved like banks in every practical sense, but they were regulated far more loosely than national banks. They were not required to hold the same cash reserves. They were not members of the New York Clearing House, the private consortium of banks that acted as an informal safety net during crises. By 1907, trust companies in New York held more assets than the national banks themselves, and almost nobody outside the industry understood how thin their reserves actually were. This was not an accident of history. It was the direct result of a regulatory gap that a handful of financiers understood intimately, because some of them had helped keep it open. The spark came from a man named Fritz Augustus Heinze, a copper baron from Montana who had made his fortune through aggressive, occasionally fraudulent mining litigation before arriving in New York with ambitions to match his wealth. Heinze partnered with a Wall Street operator named Charles W. Morse, a man who had already built and lost one banking empire in the ice trade before pivoting to finance. Together, Heinze and Morse controlled a network of banks and trust companies, and in October of 1907, Heinze's brother Otto attempted to corner the stock of United Copper Company, betting that short sellers would be forced to buy shares at inflated prices to cover their positions. The scheme collapsed within 2 days. United Copper's stock, which had traded above $60 a share, fell below 10. But the real damage was not to Heinze's copper stock. It was to public confidence in every bank and trust company connected to his name, however loosely. Heinze sat on the board of the Mercantile National Bank. Depositors, reading the newspapers and drawing their own conclusions, began pulling money out of institutions that had no direct exposure to the copper scheme at all, simply because they shared a director or a rumor with Heinze's network. This is the mechanism financial historians call contagion, and it is the reason a failed copper trade in the middle of October became a systemic banking crisis by the end of the month. The regulatory gap that made trust companies so vulnerable had not appeared by accident. Since the panic of 1893, reformers inside the national banking system had periodically proposed bringing trust companies under the same reserve requirements that govern nationally chartered banks, and every proposal had quietly died in committee, in part because the men who ran the largest trust companies and the men who ran the banks that competed with them found the existing arrangement useful in different ways. Trust companies could offer higher returns to depositors precisely because they held thinner reserves, which let them undercut national banks for business. National banks, meanwhile, could point to the trust companies' fragility whenever Congress debated expanding their own lending limits. Both sides understood the arrangement was unstable. Neither side had an incentive to fix it before someone else was forced to pay the price. By 1907, New York held roughly 50 trust companies with combined resources that had grown nearly 240% in the preceding decade, expanding far faster than the reserves backing them, and far faster than anyone in Albany or Washington had bothered to track. The Knickerbocker Trust Company became the crisis's second casualty, and this is where the standard account starts to develop cracks. Knickerbocker's president, Charles T. Barney, had done business with Morse, and when the New York Clearinghouse Association began quietly investigating which institutions were tied to the collapsing copper scheme, Barney's connections put Knickerbocker on the list. Barney went to J.P. Morgan personally, asking for the kind of support that Morgan's firm had extended to failing institutions before. Morgan refused. He sent a representative to examine Knickerbocker's books, and after a brief review, he declined to intervene, reportedly telling associates that he did not believe the trust company was solvent enough to save. Whether that judgment was accurate or convenient is a question that has never been fully settled, because Morgan's refusal to support Knickerbocker triggered exactly the panic that then required his personal intervention days later. Some later examiners who reviewed the surviving Knickerbocker ledgers argued the institution had been salvageable with modest support, a conclusion that, if accurate, means the crisis Morgan spent the following 2 weeks resolving was in some measure a crisis his own initial refusal had helped create. The Knickerbocker failed on October 22nd. Depositors at other trust companies, watching a 34-year-old institution collapse in a single afternoon, began withdrawing their own money the following morning. The panic Morgan had declined to prevent at Knickerbocker was now spreading to the Trust Company of America, the third largest trust company in the country, and to a dozen smaller institutions behind it. On October 23rd, the day after Knickerbocker closed its doors, a crowd formed outside the Trust Company of America on Wall Street that a New York Times reporter on the scene described as stretching around the block before the doors even opened. Inside, tellers paid out cash as fast as clerks could count it, in some cases simply handing depositors stacks of bills without stopping to verify the exact amount, in the hope that visible speed would slow the line outside rather than accelerate it. It did not work. By early afternoon, the company's cash reserves had fallen to a fraction of what its deposits required, and its president, Oakley Thorne, sent word to Morgan's library that the Trust Company of America would not survive the day without emergency support. This time, unlike with Knickerbocker, Morgan chose to act, dispatching an examiner within the hour, and after a hurried review of the books, concluding that the institution was fundamentally solvent and worth saving. The decision to rescue the Trust Company of America, while allowing Knickerbocker to fail, has never been fully explained in terms of the underlying balance sheets alone. Contemporary bank examiners who reviewed both institutions after the panic found their capital positions more comparable than Morgan's public statements at the time suggested, which has led generations of financial historians to ask, without ever securing a definitive answer, whether personal relationships and competitive rivalries among the trust company presidents played as large a role in Morgan's decisions as the numbers in front of him. What happened over the next several days is the part of the story that gets told with the most reverence, and it deserves some of that reverence because it is genuinely remarkable. J.P. Morgan, 70 years old and in poor health, effectively became the central bank of the United States for 2 weeks. Working out of the private library of his mansion at Madison Avenue and 36th Street, he summoned the presidents of New York's major trust companies and banks, examined their books through a team of accountants he assembled overnight, and decided in real time which institutions deserved emergency loans and which would be allowed to fail. He organized a rescue fund, pressuring the presidents of solvent banks to contribute capital to a pool that would backstop the weaker trust companies, and he personally guaranteed some of the largest loans. On the night of November 2nd, he locked a group of bankers in his library and refused to let them leave until they signed an agreement to save the Trust Company of America, a scene that has become one of the most famous set pieces in American financial history. Rockefeller, watching from a distance, publicly pledged $10 million of his own fortune to the effort, a calculated gesture that helped calm the markets and burnished his own reputation at a moment when Standard Oil was under federal antitrust investigation. By the second week of November, the acute phase of the panic had passed. The stock market had lost nearly half its value from its 1906 peak. Dozens of banks and trust companies had failed nationwide, and an estimated business contraction followed that lasted through much of 1908. But the system, battered and reorganized, had not fully collapsed. Morgan was celebrated in the press as the man who had single-handedly saved American capitalism, and in most retellings since, that is where the story ends. It is not, however, where the financial record ends, and this is the part historians tend to treat as a footnote rather than the center of the story it actually is. In the final days of the panic, with the Trust Company of America still teetering, Morgan's associates approached the leadership of U.S. Steel with an unusual proposal. The Moore and Schlee brokerage firm, one of Wall Street's larger houses, was on the verge of collapse, and its collateral included a controlling interest in the Tennessee Coal, Iron, and Railroad Company, one of U.S. Steel's largest remaining competitors in the southern iron and steel market. Morgan's plan was straightforward. U.S. Steel would acquire Tennessee Coal and Iron, absorbing Moore and Schlee's debt and removing a major competitor from the market in the same transaction that stabilized the brokerage house and, by extension, the broader panic. There was one obstacle. The Sherman Antitrust Act, passed in 1890, existed precisely to prevent this kind of consolidation, and U.S. Steel already controlled roughly 60% of American steel production. Acquiring its largest remaining rival would have drawn immediate scrutiny under ordinary circumstances. The circumstances were not ordinary. On the night of November 4, 1907, Judge Elbert Gary and Henry Clay Frick, representing U.S. Steel, boarded a night train to Washington and secured a personal meeting with President Theodore Roosevelt before the stock market opened the following morning. Roosevelt, a president who had built his political identity around trust busting and had already filed antitrust suits against Standard Oil and the Northern Securities Company, agreed within hours not to pursue an antitrust challenge against the acquisition. He later explained his decision by framing it as a matter of averting a national financial catastrophe, stating that he did not believe it was his duty to interpose an objection during a moment of genuine crisis. The deal closed. U.S. Steel absorbed Tennessee Coal and Iron at a price historians and contemporary critics alike considered well below its actual value, and the acquisition eliminated the last significant competitive threat to U.S. Steel's dominance of the American steel industry for a generation. When the deal was later scrutinized by a congressional committee and, separately, by a federal antitrust suit filed against U.S. Steel in 1911, testimony revealed that Moore and Schley's crisis, while real, may not have been severe enough to require the sacrifice of an entire independent steel company, and that the panic had provided Morgan's interests with a justification and a compressed timeline that made the acquisition far easier to secure than it would have been in ordinary times. The panic of 1907 did not merely give Morgan the opportunity to play hero, it gave U.S. Steel the opportunity to eliminate a competitor with the implicit blessing of a president who, in any other week, would have fought the deal in federal court. The financial record from the panic contains other details that complicate the hero narrative further. Charles Barney, the Knickerbocker president whose institution had been the panic's original trigger point, took his own life a week after the crisis began, having lost both his fortune and his standing in a matter of days. The presidents of several failed trust companies faced criminal indictments in the years that followed, while the largest financial institutions that had absorbed weaker competitors during the panic emerged from the crisis significantly larger and more concentrated than before it began. The trust companies that survived did so largely on terms dictated by Morgan and the small circle of bankers he assembled in his library, terms that in several documented cases required the surviving institutions to accept new leadership or ownership arrangements favorable to the rescuing banks. A crisis that began as a failed copper speculation ended with the American banking and steel industries measurably more consolidated in the hands of fewer men than they had been 2 weeks earlier, and the man who orchestrated the rescue was also, by any reasonable accounting, one of its principal beneficiaries. Barney's suicide note, released to his family and later summarized in newspaper accounts, made no direct accusation against Morgan, but it described a man who believed his exclusion from the rescue effort had been as much a verdict on his standing among his peers as it was a judgment on Knickerbocker's balance sheet. 2 of the trust company presidents who survived the panic later testified, in depositions connected to subsequent litigation, that they understood participation in Morgan's rescue pool as a condition attached to their institution's continued access to clearinghouse support, a condition that in practice meant accepting oversight from bankers who, in several cases, ran competing institutions. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. The panic's most consequential legacy, though, was not the steel acquisition or the failed trust companies. It was the argument it handed to men who had wanted a central bank for years and had never had a crisis dramatic enough to justify one. The idea that the United States needed some form of central banking authority was not new in 1907. Economists and bankers had debated it for decades, and previous panics in 1873, 1884, and 1893 had already exposed the fragility of a currency system with no institution capable of expanding the money supply during a liquidity crunch. What the Panic of 1907 provided was a vivid, front-page demonstration of the argument's most persuasive form. If the stability of the entire American financial system depended on the personal judgment and private fortune of one 70-year-old man working out of his home library, then the country had a problem that went beyond any single panic. Congress agreed. In May of 1908, it passed the Aldrich-Vreeland Act, creating a National Monetary Commission chaired by Senator Nelson Aldrich of Rhode Island, and tasked with studying banking systems around the world and recommending reforms. Aldrich was, in almost every meaningful sense, a representative of the same financial world that had just weathered the panic. His daughter Abby had married John D. Rockefeller Jr. in 1901, tying the Aldrich family directly to the Rockefeller fortune that had helped stabilize the crisis. Aldrich spent nearly 2 years touring European central banks, and in November of 1910, he convened a small, secretive meeting on Jekyll Island, a private resort off the coast of Georgia, owned by a syndicate of wealthy families that included the Morgans. The men who attended traveled under first names only, told their families they were going duck hunting, and spent 9 days drafting what would eventually become the blueprint for the Federal Reserve System. Among them were Henry P. Davison, a senior partner at Morgan's own firm, Frank Vanderlip, president of the National City Bank, and Paul Warburg of Kuhn, Loeb and Company, one of the most sophisticated banking theorists of his generation. For more than 2 decades after the Jekyll Island meeting, every participant who was later asked about it either denied it had taken place or declined to discuss it, and the trip only entered the public record in detail after Aldrich's biographer published an account of it in 1930, drawn largely from the recollections of Frank Vanderlip, who by then felt free to describe how carefully the group had guarded its secrecy, using only first names, arranging for their private rail car to be attached quietly to a scheduled train, and instructing the resort staff not to record the names of the guests. The plan they produced initially failed in Congress, in part because Aldrich's name was too closely associated with Wall Street to survive a political climate still shaped by progressive-era suspicion of concentrated financial power. It was reworked under Democratic sponsorship, given new authors in Representative Carter Glass and Senator Robert Owen, and passed in December of 1913 as the Federal Reserve Act. The same year Congress ratified the 16th Amendment and created the modern federal income tax. The institution that emerged bore the structural fingerprints of the men who had drafted it on Jekyll Island, a system of regional reserve banks that, in its earliest decades, remained closely intertwined with the private banking interests it was ostensibly created to oversee. This is where the standard telling of the Panic of 1907 tends to stop short of its own implications. The official narrative treats the crisis as the event that proved America needed a central bank, full stop, with Morgan cast as the flawed but ultimately heroic figure whose improvised rescue exposed the system's weakness. That version is not false, it is simply incomplete. It leaves out that the men most active in describing the panic's lessons to Congress were largely the same men who had personally profited from the crisis or stood to benefit from the institutional arrangement that followed it. It leaves out that the National Monetary Commission's chairman was related by marriage to one of the panic's most visible rescuers, and that the men he selected to help design the Federal Reserve System were partners and associates of the firm that had run the 1907 rescue out of a private library. It leaves out that the same crisis which established the case for a central bank also delivered U.S. Steel its last major domestic competitor at a fraction of fair value, with the sitting president's antitrust objections waived in a matter of hours during the crisis's most acute moment. None of this requires believing the panic itself was manufactured. The copper corner that triggered it was real, reckless, and driven by men with no connection to Morgan's circle. But the way the crisis was resolved, and the institutional architecture that was built in its aftermath, served the interests of a remarkably narrow group of financial actors with remarkable consistency. There is a version of this history, more common among financial historians than among the general public, that treats the events of October and November 1907 less as an emergency and more as a demonstration project. The panic showed, in the starkest terms possible, what the country's financial elite had been arguing privately for years, that a modern industrial economy could not safely run on a currency system with no lender of last resort, and that the alternative to a central bank was a system in which private citizens with enormous personal fortunes would periodically be called upon to save it, at whatever price they chose to extract in return. Morgan extracted Tennessee coal and iron. The banking interests who benefited from the panic's resolution extracted a National Monetary Commission chaired by one of their own relatives. And when the Federal Reserve Act finally passed in 1913, it created exactly the kind of institution that men like Warburg, Davison, and Vanderlip had spent years arguing for, one structured closely enough to their own recommendations that a Senate investigation years later would describe the final bill as substantially unchanged from the framework first drafted on Jekyll Island. The broader economy paid a price for the panic that rarely makes it into the hero narrative at all. Industrial production fell by roughly 11% in the year that followed. Unemployment climbed sharply in manufacturing centers across the Northeast and Midwest, and an estimated 250,000 workers lost their jobs in New York City alone during the contraction that economists now date from the panic's onset through the middle of 1908. Small businesses that depended on short-term credit from local banks found that credit simply gone, since the same banks that had weathered the panic by tightening reserves were unwilling to extend new loans while uncertainty remained high. None of these effects touched the men who negotiated the panic's resolution in any comparable way. Morgan's firm ended 1907 with its position in American finance strengthened rather than diminished. U.S. Steel absorbed a competitor it would not otherwise have been permitted to acquire. And the political momentum that followed pointed toward exactly the kind of institutional reform that the same circle of bankers had favored for years, a reform that would, in theory, prevent the next panic from requiring their personal intervention, and that would, in practice, formalize their influence over the country's money supply rather than eliminate it. What the Standard account gets wrong about the Panic of 1907 is not the sequence of events. The Copper Corner happened. The Knickerbocker failed. Morgan's library rescue happened largely as described, and it likely did prevent a far deeper collapse than the one the country actually experienced. What the Standard account gets wrong is the framing. The idea that 1907 was simply a natural disaster that the financial system survived through the heroism of one man, rather than a crisis whose resolution was actively shaped, and in several documented instances directly negotiated, by the very men who stood to gain the most from both the immediate rescue and the regulatory architecture that followed it. The panic exposed a genuine structural weakness in American banking. It is also true that the men who diagnosed that weakness for Congress, who drafted the legislative response, and who absorbed the panic's weakest competitors into their own portfolios were, in nearly every documented instance, the same small circle of financiers who had gathered in Morgan's library in November of 1907, deciding which banks would live. The Pujo Committee, a congressional subcommittee that investigated concentrated financial power between 1912 and 1913, would later document just how small that circle actually was. Its final report found that a handful of financial institutions, centered on Morgan's firm and its closest allies, sat on the boards of companies controlling a combined capitalization in the tens of billions of dollars, an interlocking network the committee's own counsel, Samuel Untermeyer, described as a money trust operating with more concentrated financial power than had ever existed in the country's history. Untermeyer's questioning of Morgan himself, conducted in December of 1912, produced one of the most quoted exchanges in the history of American financial regulation. Asked whether commercial credit was based primarily on money or property, Morgan answered that it was based on character first, telling the committee that a man he did not trust could not get credit from him on all the bonds in Christendom. The answer was widely reported as a moment of old-world integrity from a banker nearing the end of his life, and in some respects it was exactly that. But Untermeyer's broader line of questioning was aimed at something less sentimental, the demonstrable fact that credit in America in 1907, and for years afterward, flowed through a network of personal relationships concentrated among a few dozen men who sat on each other's boards, examined each other's books, and decided, often informally and without any statutory authority, which institutions would be permitted to survive a crisis and which would not. Morgan died in Rome in March of 1913, 9 months before the Federal Reserve Act became law, and the committee's findings, published shortly before his death, gave momentum to the argument that whatever replaced the informal system he had presided over needed at least some layer of public accountability built into its design. The Pujo hearings ran in the same congressional session that produced the Federal Reserve Act, and Untermeyer's findings gave reform-minded legislators like Carter Glass and Robert Owen the political cover to insist on public oversight provisions in the final bill, provisions that softened, though did not eliminate, the private banking influence baked into Aldrich's original Jekyll Island framework. Even the corrective, in other words, was shaped by the same crisis and the same cast of characters. The Panic of 1907 did not simply reveal America's need for a central bank. It revealed, in exhaustive and uncomfortable detail, exactly who would be trusted to build one and exactly what they stood to gain from the assignment. More than a century later, the Federal Reserve System that emerged from Jekyll Island still governs the American money supply, still sets the terms under which credit expands and contracts across the economy, and still operates through the same regional structure that Aldrich's commission first proposed. U.S. Steel, though a shadow of its early 20th century dominance, exists today as a direct descendant of the company that absorbed Tennessee Coal and Iron in the final desperate week of the panic. The trust companies that survived 1907 by accepting Morgan's terms became the ancestors of some of the largest financial institutions in the modern American banking system. The architecture built in the panic's aftermath did not merely respond to a crisis. It encoded the interests of the men who resolved it into the permanent financial infrastructure of the country, and that infrastructure has proven remarkably durable, surviving the Great Depression, the deregulation of the 1980s and 1990s, and the 2008 financial crisis that so closely echoed the events of a century before. When Lehman Brothers collapsed in September of 2008 and the federal government scrambled to decide which institutions were too significant to fail, it was doing, with considerably more legal authority and considerably less discretion, something close to what J.P. Morgan had done alone in his library in 1907. Treasury Secretary Henry Paulson, a former head of Goldman Sachs, convened bank presidents in a conference room rather than a private library, and the decisions about which firms would be supported and which would be allowed to collapse were made under statutory authority that did not exist a century earlier. But the underlying dynamic, a small circle of the most senior figures in American finance and government, determining in a matter of days which institutions would survive, was recognizably the same arrangement that had governed the country's financial system since 1907, now formalized, expanded, and given the force of law. The Federal Reserve itself, the institution built specifically to remove that kind of discretionary power from any single private citizen, ended up exercising something close to it during 2008, extending emergency credit lines that reached into the trillions of dollars, with a degree of latitude over which firms received support that would not have looked entirely unfamiliar to the men who gathered on Jekyll Island in 1910. The question of who gets saved during a financial panic, and what they owe in return, did not end with the creation of the Federal Reserve. It simply moved from a private library on Madison Avenue into the permanent architecture of the American state, built, in no small part, by the men who had the most to gain from designing it. Historians who study the Panic of 1907 closely tend to arrive at a more unsettled conclusion than the one taught in most classrooms, not because Morgan's rescue was fraudulent and not because the Federal Reserve was created in bad faith, but because the men who diagnosed the crisis, negotiated its resolution, and designed the system meant to prevent its recurrence were never disinterested observers. They were participants with outcomes riding on every decision they made, and the institutions that emerged from their work still bear the shape of the hands that built them. A century later, the ledgers, the depositions, and the congressional transcripts remain part of the public record. What they show has never quite matched the version of the story that made it into the textbooks. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.